One of the strongest catalysts for a stock is an earnings release. But quite often the headlines are misleading and not truly what the earnings are and what the guidance is. In today's video, we're going to spend some time teaching you how to accurately identify what the earnings and guidance are, and that way you'll be more prepared and not get caught in the wrong direction. Hi, I'm Steve Spencer. I'm a partner at SMB Capital. We're a proprietary trading firm in Midtown Manhattan where we trade stocks, futures, and options. So as short-term traders, we're looking for stocks with strong catalysts. Strong catalysts will attract large buyers, large sellers. These participants can push a stock very quickly in one direction or the other. We attempt to understand how far a stock will move based on past trading activity and the magnitude of the catalysts. One error some traders make is to trust headlines and media hype. As a trader, you need to dig a little bit deeper and never trust the headlines. Lulu had a very strong quarter, but they did not raise future guidance a significant amount. They had a large beat for the current quarter and then raised guidance a little bit for the rest of the year. The stock reacted strongly to the large beat and gapped up very quickly in after-hours trading. Some people were fooled by the guidance. There are things to consider post-catalyst. How has the stock moved prior to the catalyst? How are market participants' positions coming into the catalyst? Was the catalyst good or bad? And what was the magnitude of how good or bad that catalyst was? When we consider all of those things together, we can create expectations for how large market participants will react to the news. Will they push a stock up intraday or down intraday? How will things unfold in the coming days? In the case of Lulu, what we want to do is examine the price action prior to the earnings release, what happened after the earnings release, and some of the tweets that came out once the earnings were released as well. When the earnings came out, I tweeted right after, about an hour after the earnings came out, solid numbers from Lulu. Don't be fooled by the guidance, which simply took into account the current quarter's beat. And the reason I tweeted that out was I noticed a very bullish tweet from a fund manager who said they beat by quite a bit and the guidance was quite strong. And this is one of the more common errors. I was kind of a little bit surprised by that this was a professional fund manager tweeting this out. So let's take a look at the actual numbers here. Q1 revenue was $2 billion. Expectations were 1.92. So this is an $80 million beat. Not bad. The earnings per share beat was larger than the revenue beat, and that's really what drove the stock up initially. And then they raised guidance. As short-term traders, we always want to know, are companies lowering guidance going forward, raising guidance going forward? Are they doing it for the next quarter, for the next year? And really drilling down, because that's what, if there's a big move there on guidance, that can sustain a large gap in either direction and also lead to follow through. So what did they do on 2023 guidance? They raised it to 9.44 to 9.51 billion. Prior estimates had been 9.37 billion. So this is a raise of 70 million on the low end of their new guidance to 140 million on the high end. And so we just discussed they beat in Q1 80 million. So you can see the midpoint of this guidance is about 1% above prior expectations. This is not moving the needle much. It's good that they raised guidance and they gave it a little bit of room on the upside of that range for maybe a little bit more of a beat going forward over the next 3 quarters, but it really was de minimis and not something that we should expect upside follow through. So if anything, what we're thinking is if it's a large enough gap, maybe there'll be a pullback. And we'll get into that when we take a look at the charts and the price action. Now, before we get into that, what I wanted to do was give you an example of just a recent earnings guidance that really did move a stock and led to upside follow through. So in the case of NVIDIA, they reported their first quarter and they gave second quarter guidance. Expectations had been for around $7 billion. They raised that to $11 billion. That's right, that's not a mistake. In fact, when the news guy was reading it, when they reported, he initially said $11 billion for the year, which was incorrect. It was for actually next quarter, $11 billion plus or minus 2%. That's more than a 50% increase in guidance versus what we just looked at with Lululemon, which was a 1%. So best case scenario for Lululemon is like maybe we can hold, a decent percentage of that gap, or we won't fill that large gap because it had a really nice quarter. But the guidance should not be enough for upside follow through. And that's kind of when we take a look at what my trade planning was and how I was thinking about it, you'll kind of see how that comes into play. All right, so first thing, we'll take a look at the big picture in Lululemon. This shows the last 2 quarters. I wanted you to see what happened on last quarter's earnings report and kind of bring it into this earnings report. So last quarter, the stock was down around 320. They had a really nice quarter, but the thing that moved it was after the earnings release was a really significant raise in guidance. And you can see it gapped up to around 360. They ran it up to 380. It actually even reversed intraday and was down in the 360s for a few days before it started to crawl back up and hit 380 a couple of weeks later. So you can see even the prior quarter, when there was a really nice number, really nice guidance, it was just enough for it to hold 360 on a pullback from the open, a pretty hard intraday down move, and then trended higher and then failed in the mid 380s. And so that was the context coming into this quarter. And I think that I actually, here, I grabbed a screenshot of the reaction from last quarter. You can see the gap up to 360, and then in the pre-market, they walked it up to like 375. And you can see intraday, they just sold it off all day into the low 360s. So that was last quarter. And then if you can see coming into this quarter right here, I circled these 2 areas. It actually was sold off for the week ahead of earnings from 380 all the way down to, looks like around 330 or so. And when the earnings came out initially, it dipped down, a little bit of confusion. This often happens right after the earnings are released, but then very quickly released back up into the 360s. And I actually started to short some in the after hours, I believe in the 365 to 370 area, small. We wanted to see kind of how it would finish the after hours into the next day. And the reason why I started to short it on the pop back up to here was my expectation was on the very small change of guidance, despite the beat for the quarter, that eventually cooler heads would prevail the following days and it would start to pull back at least to like, the 360 to 365 area. So we come in the next day, and based on the after hours price action where it traded up into the 370s and based on what it was doing in the pre-market, my inflection point, and I get asked this often, inflection point is right on the open. If the stock opens above that level, I'm looking to see if it will spray up into R1, R2. If it opens below that level, pull back to S1, S2, and then depending on my bigger picture bias, that's how I'll react at those levels. In the case of this, where my bigger picture bias was to the downside because of what we just discussed with the forward guidance, if it spikes from the inflection up to R1, R2, I'm going to be pretty aggressive getting short. And then if it comes back down and gets below inflection, I'll look for it to come into S1, S2. And then furthermore, if it can start to intraday consolidate after pulling back below S1, look to see if it will work its way down to S3 eventually and close at or near the low and play it for a second day play for further downside. All right, so here's the chart. And you can see I've marked it up with R1, R2, I for inflection, S1, S2. And what you can see is right on the open, it opened above inflection. It actually very quickly dropped to inflection, went straight up to about 380. Second move took it up actually past R2, I think maybe almost to R3. And I started to short between R2 and R3. And as it came back down, what you look for in that case is you want it very quickly to get down below R1. So I never take for granted. My big picture view was the guidance wasn't that good. I think that it should trade back down to inflection, eventually trade down to S1 or S2. But, other people might think other things, especially on day one. The larger funds might not digest this news to day 2, day 3, day 4. And so what I want to see is when I'm shorting here is it very quickly get back down below R1. Now it did that. If it had come back down to R1 and started to support in this 380 area, 379, and it hadn't very quickly come down to inflection and actually traded below, I would start to cover pretty aggressively and look for it to show me intraday that it would be weak. It had the nice reversal, got below inflection, and then this was a point, if you were a trader, more conservative trader, and you were just looking for the failure on the open, gets down below the morning low here, which it did, and starts to hold below inflection, this is where you can establish a position on the short side initially against about 377.5, these spike highs right here, and then look to trade it into S1, take off profits to S1 and play it down to S2. I thought what made the stock a little bit confusing later in the day was after it came to S2, the way it supported here and started to curl back up, in that case, what I want to see if it's going to trend all the way down to S3 intraday is fail here, but it didn't. It held and then it broke to the upside. So that's a case of if you shorted back into S1 here, you would have been stopped out on this bar here and then came right back down below. Would be fine as it started to then hold, basically couldn't sustain above S1. If you wanted to add back into this weakness or usually I like to add back into the pop, into prior resistance, into the prior support level, now it becomes resistance with a stop above here. And then it ended up working rest of the day, closed at the low, and that sets us up for next second day play. For those of you who aren't familiar with second day plays, go to tradingworkshop.com. It's a 2-hour free workshop. I spend, I think about 20 minutes teaching the second day play trading setup. What I love about the setup, the second day play, is even brand new novice traders can make this trade. It's just very well defined. You have good information from day one. You have levels. It's a high percentage play. It's not as volatile as day one. So I think I spent 20 minutes on that. I also spent 30 minutes on stock selection, which a lot of people seem to be confused on. But both of those lectures, and then I think Mike gives 1 or 2 lectures on that workshop as well. It's well worth your time and doesn't cost you a penny. Second day play, we have our resistance levels based on day one. We have our support levels based on the longer, higher time frame. And I should say that on day 2, that 352 level is around $30 plus from the intraday high on day 1. And that's the point now where I think we've erased about 50% of the gap and where I would be thinking, okay, 350, 352, maybe we can kind of start to buy some 360 calls for maybe a month out. Bigger picture players might actually be interested in getting long this again. Maybe this will work its way back up over the next quarter or two, back up to $380, $400 or something like that. But for the intraday trade itself, still looking for downside follow through because of the weakness on day 1 and the guidance. So here's day 2. What I like to do on day 2, right on the open, is hopefully catch a spike, even though it was weak on day 1 to prior day's resistance. We didn't get that. The first move is down. So how do you play it for downside, assuming you're not still short some from day 1? If you're short from day 1, usually traders will hold about a quarter of their position, and they'll have some for the gap down. But like say you came in flat and you're just looking for a pure second day play, initiating a new short position, and the first move is down, what you look for is when it comes down to S1 and flushes through and comes back up, you want to start to short back into to where it opened, basically. And so in this case, it opened at, 363.5, 364. And when it comes back up and gets to within 50 cents of the opening price, start to short a little bit more into the opening price, put a stop $1 higher because the stock will move $5 to $10, so it's okay to risk $1 on it. And then once it gets up there, and if you can get a consolidation below S1, which you didn't get, it just kind of went straight down to S2. But if you did come down here and got a consolidation, that would have been a spot to add. But in this case, only what you got on the spike back up to the open would you ride down to kind of S2. And then same thing, I guess, is on day 1. It moved sideways at S2. It actually supported there. You could try the same thing. It actually kind of did what it did on day 1, where it spiked up to the level. It got a little bit through, but not much. You definitely could have shorted it into S1 and probably wouldn't have been stopped out. Assuming you took a bunch of profits here and tried to ride it back down to S2 into the close, which I think it did almost get down there. I don't know what it did on day 3. I think eventually on day 4 or 5, it eventually got down to S3. And even in today, it might actually be bouncing finally back up to 360. Just from a bigger picture, if it starts to have closes back above 360, that'll be the beginning of a move, potentially moving back up into the price levels from where it started on day 1. Anyway, hope you learned something here. The bottom line is when companies report and they beat by a certain amount for the quarter, when you see what they're doing for the fiscal year guidance, they need to raise by at least double what they beat for the quarter for it to be a significant raise. And quite frankly, you want to see a lot larger raise than that to look for at least holding the gap or further upside follow through. Hope you learned something. I'll see you next time.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition, the traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we've found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with S&B to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.